Hi, this is Dr. Najib Omar. Today I want us to look at the double entry concept part 2, where we want to look at the effects of transaction on our accounting equation. I want us to look at the accounting equation once again, and we saw that assets are equal to owner's equity and liabilities. By now you should be able to know what assets are, what is owner's equity and liabilities. A quick recap therefore I want to show you. Assets are items of value owned by the business. Any item that has value, we are going to look at the examples of each. So all these belong to assets. Then when we refer to owner's equity, these are funds of a business provided by the owners, and they also include any profits accrued to the business. Then we have liabilities. Liabilities here are debts owed by a business to external parties such as creditors or suppliers. Then we have examples. So we have examples of assets here. We have building, motor vehicle, office equipment. All these are examples of assets. On the other side of the balance sheet, we have capital, and any profits will be added to the capital as owner's equity. And the last item on the balance sheet, which is liabilities, we have examples there as creditors, any loan from the bank, and any other items which are payable by the business. So all these can be classified as other creditors. Now, having seen this balance sheet equation or an accounting equation, remember it is important that whatever transaction we undertake, it will affect two items of our accounting equation, and this equation should be able to balance at all the times. That is why we have the double entry system, because it should affect two items and at the same time the equation will still balance. Now let us look at our accounting equation and several examples of transactions that will affect our accounting equation. We have transactions that affect both assets and liabilities. Now, we may have a transaction that will affect asset and liability such that that particular transaction increases the asset, at the same time it also increases the liability. Now, in this case, I want us to look at an example where a business takes a bank loan. So when a business takes a bank loan, then the liability will go up. So if we get the cash from this loan, then it means our assets in form of cash will also increase. So that transaction where we take a bank loan will increase the liability and also will increase the asset. Then we may also have an example where we have a transaction where our assets will reduce and our liability will also go down. A good example here is when we have a liability in form of creditors. You know that creditors, we need to pay them. These are our suppliers and we got goods on credit. So we pay our suppliers will go down, and because we are paying through cash, then our cash will also go down. Then we may also have other transactions that affect both assets and owner's equity. Now we may have a transaction where assets will increase and owner's equity will also increase. A good example here is when the owner has introduced any additional capital. When he introduces any additional capital, then owner's equity will increase, and because that capital is in form of cash, then the assets will also increase in form of cash. On the same aspect, we may also have a transaction that decreases the asset and also decreases the equity. A good example here is when we have the owner withdrawing some cash from the business. So when the owner withdraws some cash from the business, it reduces the owner's equity. And at the same time, because the owner has taken some cash, our cash also will reduce. We may also have other transactions that affect assets only. Now, we may have a transaction that may increase one asset and decrease another asset. A good example here is when we use cash to buy an equipment. So when you use cash, your cash will reduce. And to buy an equipment, that means your fixed assets as an equipment will increase. We may also have a transaction that affects liabilities only. That means one liability goes up and one liability goes down. A good example here we can look at is when you acquire a bank loan. When you acquire a bank loan, that means one liability increases and you use that loan to pay off your creditors. So the creditors as liability will go down. Now, let us look at several examples here. We want to look at different types of transactions that will show some effects on our accounting equation. Remember to have your accounting equation up there. These examples which I'm about to give you are not related to each other. So let us look at each transaction separately. The first one here, we see Adil began business with cash in hand, $5,000. Now, when you see such a transaction, you need to identify which accounts are being affected. Here, you can see that we have cash being introduced, and this cash is in form of capital. So we have two items there. We have cash and capital. Capital has been introduced, that means $5,000 has increased. Capital has increased, and on the other side, cash has also increased by the same amount, which is 5,000. The second example here, we have the firm taking a bank loan of $8,000. So you can see here, when you take a bank loan, this is a liability. You need to pay this loan after some time. If it is long term, then we can say that this is a long-term liability. So when we take a loan, two accounts are affected again. We have the liability, and because the loan is given in form of cash, then we also have cash as the other item in the balance sheet. So we have the bank loan increasing by 8,000 and cash also increasing by 8,000. The third example here, when we purchase motor vehicle from Bahwan Trading for 2,000. So if we are using cash, that is the first item. So cash will reduce by 2,000, and because we are buying a fixed asset, which is another asset, here the asset will increase by 2,000. So you can see one asset has increased and the other asset has reduced. Another example here, we have payment of 500 to creditor. When you pay to a creditor, that means your cash will reduce. And on the other side, if you have creditors worth 2,000, then your creditors have reduced by only 500. So this here, this transaction affects cash, it has reduced cash, and it has also reduced our creditors. Then we have another transaction here, when we receive an amount in form of a check from a debtor. Now, remember, debtors are our clients whom we have sold the goods on credit, so they need to pay us. So when we receive any amounts from them, then the debtors have reduced. And because we are receiving this amount in form of a check, then our bank account will increase by the same amount. So you can see here our debtors have reduced and our cash has increased by the same amount. Another example here, when we make a payment or a repayment of a bank loan. Remember, if you took a loan, it's a liability. So when you make a repayment, then you're reducing that particular liability. And when you use cash to make payment of this loan, then your cash will also reduce. So we have such a transaction whereby our cash will reduce by 1,500 and our bank loan will also reduce by the same amount, 1,500. Another transaction here is when we make a purchase of office equipment on credit. here you can see we are acquiring a fixed asset. So our fixed assets will increase, and because we are buying this equipment on credit, then our liabilities will also increase. So we have an increase in our assets and an increase in our liabilities. Having looked at all these examples of transactions, you can see that our accounting equation, where assets should always be equal to owner's equity and liability, all these transactions have to balance. In my previous video, we looked at the balance sheet and we said that the balance sheet is a statement of a financial position. It is a report that is used to present the accounting equation which we have looked so far. And the accounting equation shows the assets, the owner's equity and the total liabilities over an accounting period. So it is important that we know the format as illustrated in my previous video. So here we have the format. We have our accounting equation up here. This is just for your guidance, but remember, you can decide which side to be the assets and which side to be the owner's equity and liabilities. In this example, we see that we have this side fixed assets and current assets. So assets have already been classified for you. We have fixed assets, examples there, building, office equipment, motor vehicle, fixtures, furniture. Then we have current assets. Current assets here given as stocks, debtors, bank and cash. So on the other side we have owner's equity. We have capital. Remember, any profits should be added to capital. Any drawings from the business for personal use should be deducted from capital. Then we also have two classification of liabilities down there. We have long-term liabilities, a loan from the bank to be repaid for a long period of time. Then we have current liabilities, we have creditors, we have other creditors or payables by the business. Now, I want us to look at a good example here. We have an example here that shows a statement of financial position for this specific business. So you can see here we have fixed assets on one side and current assets that total to 35,050 as fixed assets. Then we have 12,600 as current assets. The total assets here are given as 47,650. On the other side, we have owner's equity, capital alone, 38,000. Then we have long-term loan, which is from the bank, 3,000. Then we have creditors as the only current liabilities at 6,650. So you can see here our balance sheet is balancing at 47,650. So let us look at how a transaction may affect our statement of financial position given each type of transaction. Make sure you have your accounting equation there. So we have assets on this side and owner's equity and liabilities on the other side. So let us look at each of the following transactions and how they may affect our balance sheet. So the first one here is the owner brought in cash 2,000 as additional capital. So we have capital here which is 38,000. So 2,000 has been brought in as additional capital and it is in form of cash. Remember, capital can be brought in form of different assets, either cash or even an equipment, right? So we have 2,000 here and it has increased our cash from 630 by 2,000. So we have our cash now 2,630, and because that was additional capital, then our capital has increased from 38,000 to 40,000. So let us look at the next transaction and how it will affect again our balance sheet. So the next transaction here, we have the owner paying off some loan. So we have a bank loan of how much? 3,000 there. So if we pay off 1,000, that means our bank loan will reduce by 1,000. And because we are using our cash has now increased. We have 2,630. Of course, we can use it to pay off some of our loan. So we reduce 1,000 from cash. So our cash will reduce now by 1,000, and our bank loan will also reduce by 1,000. Now, it is important that we take control of all these transactions. We record all these transactions before we are able to do the final balance sheet, so that we know our financial position. Next, we have the owner paying off some creditors. So we have creditors here. How much are our creditors? 6,650. And we still have some cash there, so we can pay off some of the creditors. So if we pay the creditors, our cash will reduce further by 1,100, and our creditors will also reduce by 1,100. So if you look at this, all these transactions we should be able to balance in our balance sheet. So at the end of this, we are able to look at our balance sheet, and the final position here, you can see all these three transactions affected our cash, it affected our capital, affected our long-term liabilities, and also affected our current liabilities. So you can see here at the end of these transactions, we are able to balance again at 47,550. This brings us to the end of our session. I hope you have enjoyed and learned a lot from our discussion of today. I will be doing more videos in the coming days. Please, if you have any question, do not hesitate to contact me. My email address is there. Remember to put in your comments there. If there is any session or any topic that you want me to tackle, please let me know so that I can be able to do it for you. Thank you very much.